Every trader learns that volume confirms price movement, yet the scoreboard reveals a harsh truth. If this fundamental belief were accurate, 90% would not consistently surrender their capital to the market's relentless mathematics. The deception runs deeper than mere misinterpretation. It represents a systematic inversion of reality that transforms retail enthusiasm into professional profit. Wyckoff observed through decades of tape reading that volume represents effort, while price movement represents result, and only their relationship reveals who controls the negotiation unfolding in real time. Consider the spectacle that ensnares countless participants. A stock explodes higher on massive volume. The story sounds compelling. Every instinct screams participation in what appears to be obvious institutional accumulation. Yet the bar closes in its lower third, and subsequent sessions drift lower on reduced volume, eventually surrendering the entire advance while confused traders wonder what betrayed them. The volume spike that seemed to confirm strength actually revealed absorption by the composite man, who used retail buying pressure as liquidity to distribute inventory at favorable prices. He taught that the tape never lies, but most traders read it backwards, mistaking selling pressure for buying strength because they worship quantity rather than quality in the volume-price relationship. When effort vastly exceeds result, when enormous volume produces minimal price advancement or suspicious closing action, larger interests are quietly meeting public enthusiasm with supply. Professional traders read these signatures as clearly as words on a page, recognizing that hope projects future outcomes, while logic measures present reality. The path to mastery begins when volume transforms from confirmation seeking to intention reading, when traders learn to distinguish between genuine strength and orchestrated deception. Discipline represents compassion for one's future self, and wisdom starts with understanding that the market's most profitable lessons often contradict its most popular teachings. Wyckoff's law of effort versus result transforms the market's chaotic noise into legible handwriting, providing the master key that unlocks institutional intent behind every price movement. He taught that the tape records a continuous negotiation between supply and demand, where volume represents the effort expended by participants, and price movement represents the result achieved through that effort. This relationship creates a mathematical framework that reveals who controls each moment of market action, replacing guesswork with systematic analysis. The law operates through three diagnostic scenarios that emerge from comparing these elements: when effort exceeds result, when massive volume produces narrow price, spreads or closes away from extremes. Absorption is occurring as larger interests quietly meet public enthusiasm with opposing supply or demand. Picture a stock surging on enormous volume yet closing in its lower third. The crowd celebrates participation while professionals distribute inventory into retail buying pressure. Conversely, when result exceeds effort, when significant price movement unfolds on relatively light volume, ease of movement indicates minimal opposition and reveals the path of least resistance. Finally, when effort harmonizes with result, normal market progression suggests temporary equilibrium between competing forces. The danger point concept emerges naturally from this analysis, representing the price level nearest to professional sponsorship, where risk is minimized and asymmetry favors the prepared trader. After stopping action demonstrates supply exhaustion through high effort yielding minimal result, the danger point sits where small defined risk unlocks meaningful reward potential. This law provides intellectual safety by establishing comparative analysis over absolute volume measurements, transforming subjective interpretation into objective evaluation. He observed that hope projects future outcomes based on wishful thinking, but logic measures present reality through the mathematical relationship between effort and result. When traders learn to read this continuous negotiation rather than worship raw volume numbers, they begin interpreting the market's true language instead of its surface deceptions, anchoring decisions in evidence rather than emotion. Accumulation unfolds as a deliberate campaign where the composite man converts panic into inventory through four distinct volume signatures that mark his methodical gathering before significant advances. Stopping volume announces itself at climactic selling extremes, operating like a dam breaking in reverse, where enormous effort meets even greater absorption capacity. producing narrow spreads that close in their upper portions, followed by automatic rallies, confirming supply exhaustion. The market's apparent weakness actually demonstrates institutional strength as massive selling pressure encounters superior buying power that quietly overwhelms the crowd's capitulation. Secondary tests validate this stopping action through the locksmith's careful examination, probing the same price levels with reduced effort and narrower spreads that demonstrate supply has genuinely diminished. These tests function as professional verification that the earlier climactic action successfully transferred inventory from weak hands to strong hands without disturbing the foundation being constructed for future markup campaigns. Within the developing trading range, absorption patterns emerge through persistent high volume, producing minimal price movement and overlapping bars with reluctant closes. This signature reveals the composite man operating like a patient art collector, where each seemingly insignificant transaction builds substantial position size without alerting casual observers to the systematic campaign unfolding beneath mundane price action. The professional purchases inventory methodically, while volatility contracts and the market appears lifeless to impatient participants. The spring formation provides accumulation's final test through temporary violation of established support on reduced volume that quickly reverses, defining the danger point where small defined risk unlocks meaningful reward potential. This apparent breakdown actually demonstrates strength as minimal selling pressure drives price below support, only to encounter immediate absorption that restores equilibrium. Wyckoff observed that the composite man never rushes his accumulation, waiting for the market to offer favorable terms rather than chasing inventory, transforming patience into the performance edge that sponsors profitable campaigns. Distribution arrives wearing the mask of strength, unfolding as accumulation's deceptive mirror where the composite man transforms retail enthusiasm into exit liquidity through systematic signatures that exploit optimism itself. Climactic buying volume at rally peaks reveals this orchestrated deception, where enormous effort produces minimal price extension or closes away from highs, indicating that institutional supply overwhelms retail demand precisely when the narrative sounds most compelling and social proof reaches maximum intensity. Upthrusts above resistance function as the locksmith's false key, appearing to unlock higher prices through wide spreads and conspicuous volume, only to demonstrate that supply dominates at critical levels where buyers feel safest. These deceptive breakouts attract final participants while professionals complete their distribution campaigns, transforming apparent strength into confirmed weakness as price surrenders the advance with authority, leaving hope stranded above support. The market begins breathing differently as distribution matures, with subsequent rallies traveling shorter distances on lighter volume, while declines expand on increased activity, revealing that demand grows tired while supply gains confidence. This deteriorating rhythm demonstrates ease of movement shifting to the downside through mathematical relationships that favor professional positioning over retail sentiment. Absorption patterns within distribution ranges mirror accumulation's methodology but serve opposite intent, where persistent high volume yields minimal upward progress and closes migrate toward middle or lower portions of ranges. The composite man operates like a patient art dealer, systematically liquidating inventory without disturbing prices until the campaign nears completion, using each rally attempt as distribution opportunity rather than accumulation signal. Wyckoff observed that the public buys at the top because that represents the moment when stories sound most convincing and emotional conviction overwhelms logical analysis. Distribution succeeds precisely because it contradicts instinctive expectations during optimistic phases, requiring discipline to recognize that apparent strength often masks the most dangerous weakness. Volume blindness emerges not from ignorance, but from the treacherous gap between understanding concepts and applying them under pressure, where sensation outruns analysis, and the brain mistakes excitement for evidence, because feeling safer than thinking requires less courage than systematic discipline. The chaser embodies this seductive trap, treating massive volume as confirmation rather than investigation, pressing entries during climactic action, precisely when absorption declares institutional intent, discovering through expensive education that high volume often marks distribution disguised as retail opportunity, where enthusiasm transforms into inventory transfer. The averager arrives with mathematical stubbornness, fighting clear distribution warnings by interpreting high-volume decline bars as value opportunities, adding inventory while volume continues, declaring supply dominance with mechanical precision. This archetype's systematic defiance stems from anchoring bias that transforms original purchase prices into emotional support levels, creating the dangerous illusion that cheaper prices automatically represent better opportunities, regardless of underlying supply-demand relationships revealed through effort-result analysis. The impatient tester possesses correct theoretical knowledge but refuses accumulation's methodical requirements, entering on preliminary signals without waiting for secondary confirmation that validates initial readings. This trader mistakes understanding concepts for mastering application, jumping into positions before danger points develop or proper tests confirm that supply has genuinely exhausted itself, surrendering positional edge through premature execution that ignores asymmetry essential for professional success. Cognitive distortions amplify these behavioral patterns through predictable mechanisms that override logical analysis with clinical reliability. Recency bias overweights the latest dramatic volume bar, while ignoring broader structural context. Confirmation bias hunts selectively for evidence supporting existing beliefs, while dismissing contradictory signals and narrative fallacy. Constructs compelling post hoc explanations that sound logical but ignore mechanical realities revealed through systematic tape reading. Wyckoff observed that hope represents the most expensive position any trader can maintain, transforming objective analysis into wishful projection that ignores present evidence in favor of future possibilities. The corrective framework demands context before conviction, tests before trades, and danger points before position sizing, recognizing that discipline represents compassion for one's future self, while markets forgive logical errors but consistently tax emotional decisions through mathematical precision that respects evidence over impulse. Mastery emerges when the market's seemingly chaotic movements transform into legible handwriting, each price bar recording the continuous negotiation between institutional intent and retail emotion until volume signatures become as interpretable as words on a page. The journey from confusion to clarity culminates through integration of philosophy, mechanical identification, and psychological discipline, creating a unified operating system where context establishes the framework, structure defines the sentences, and volume provides the grammar that reveals who controls each phase of price development. This systematic approach unfolds through natural sequence, where professional traders establish market context through structural analysis, identify signatures through effort-result relationships, wait for confirmation through secondary tests, execute at danger points where asymmetry favors institutional positioning, and manage positions based on evolving character rather than hopeful projection. The methodology transforms speculation into systematic evaluation, honoring Wyckoff's foundational insight that every campaign leaves mathematical fingerprints for those who possess the wisdom to read them. Consider how a complete accumulation campaign reveals itself through this integrated lens. A grinding downtrend reaches climactic selling, where stopping volume demonstrates supply exhaustion through enormous effort, yielding narrow spreads with closes lifting from the depths, followed by automatic rally, confirming that absorption capacity overwhelms panic. The secondary test probes identical levels with reduced effort and tighter spreads, validating that supply has genuinely diminished, while professional accumulation begins methodically transferring inventory from weak hands to strong hands through patient execution that respects mathematical relationships over emotional urgency. Absorption develops quietly within the emerging range, as persistent high volume produces minimal price movement, with overlapping bars and reluctant closes, revealing systematic inventory gathering that appears lifeless to impatient observers, but brims with institutional preparation. The spring formation provides final confirmation, as temporary violation of support on lighter volume quickly reverses, defining the danger point where small defined risk unlocks meaningful reward potential through positioning that mirrors professional methodology rather than retail impulse. Execution occurs not because stories sound compelling, but because evidence aligns through effort contracting while result improves, sponsorship revealing itself in closes near highs, and follow-through confirming ease of movement in the intended direction. Position management respects ongoing character development rather than predetermined targets, recognizing that backing up to breakout levels on modest volume signals, strength while wide spreads closing in middle ranges during upswings suggest distribution risk requiring defensive adjustment. This integrated perspective transforms market chaos into strategic battlefield where the composite man's actions are meticulously recorded for those who combine technical knowledge with psychological discipline. True confidence stems from methodical analysis that honors cause and effect principles over emotional projection, understanding that consistent success emerges through patient observation and systematic execution, rather than impulsive reaction to surface phenomena. Logic consistently overcomes noise through disciplined application. Structural understanding defeats compelling narratives through evidence-based evaluation, and patience conquers destructive impulse through methodology that respects institutional wisdom over retail sentiment, providing the robust foundation upon which all sophisticated market understanding builds its enduring success.